All right, today we're talking about reverse mortgages. What are they? What happens when a homeowner passes away? And why, frankly, I hate them. So let's get into it. First off, what is a reverse mortgage? A reverse mortgage is a loan for homeowners 62 years or older that lets them turn their home's equity into cash. And they can do that without making any payments. Sounds good, right? Well, not so fast. Instead of paying the bank pays the homeowner, but there's a catch. The loan's principal, the loan itself, grows over time with interest and fees. And when the homeowner moves out or passes away, the loan has to be paid back. So, what happens when they pass away? When the homeowner dies, the loan is due. The heirs have effectively three options. One, pay off the loan, and usually they do that by refinancing to keep the house. And typically you only have 90 to 180 days, so it happens quick. Number two, sell the home, again in a tight timeline, so that they can pay off the loan and they get to keep what's left. Or number three, they can just walk away. They can let the bank take the house back in foreclosure. And usually you'll do that if the loan's balance, what's owed, is higher than the value because it's a non-recourse loan. The bank can't come after the heirs. So it's kind of just what it is. Either way, somebody has to deal with it, and they have to deal with it pretty quickly. And that brings me to why I hate these loans. Well, for the most part. One, they wipe out the heir's inheritance. The homeowner gets the cash now, but it has to be repaid later, leaving the family with little or sometimes nothing out of the equity of the home. Number two, the house may have to be sold. And if the family wants to keep the home, they have to come up with money to pay it off or try to qualify for a mortgage themselves, which can be difficult. Number three, the fees and interest are crazy. These loans grow fast and the debt piles up over time. And then finally, number four is many seniors don't fully understand what they're signing up for. Some only realize later that they've made things harder for their family in the long run. So, reverse mortgages might be right for some folks. They're not all in all a bad thing, but for many families, they can cause more problems than they solve. Okay? Let's wrap up with a quick look at mortgage rates. This past week, inflation data shook things up. Last Tuesday's CPI report came in hotter than expected, which pushed rates higher. CPI is one of the inflation numbers that the Fed looks at. But by the end of the week, those rate spikes had kind of reversed. Why? Well, another inflation number, PPI, came in and showed inflation was still growing, but key parts of the PPI, the parts that relate to consumer inflation, were actually lower than expected. So one report high, one report low, who knows? That's a signal to the Fed that they just have to wait and see. There's one other inflation number, PCE, which is their preferred number. We need to see what that looks like as we get data on that later this month. So what does that mean for rates? Well, rates had dropped a little by the end of the week from where they were in the middle of the week, but overall the data is still mixed. Until something breaks in the economy, either unemployment spiking or recession hitting, the Fed, and therefore mortgage rates, and therefore the bond market, is not likely to move much. Rates are likely to stay higher for longer. All that told, we're right back around 7% for a 30-year fix on average in the US currently. All right, y'all got this.